Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for August 10th, 2021. And so today's trade, it's a stock that kind of encompasses a lot of the kind of themes we've been looking at recently. So one of which is this whole reopening play, as far as companies that will benefit from just the economy being fully reopened. And so, you can think about it's just a lot of those cyclical businesses, especially travel and leisure, things like that I think, have been beaten down, especially with the Delta variant, kind of raising concern again. I don't think we're going to go in any kind of shutdown whatsoever again. And, whether it's kind of a short-term mask thing until this variant kind of works its way through, which I think if you look at the numbers, we're already kind of peaking. I think in a lot of these states like Florida that we're really breaking out, and so I think we're coming over the hurdle already, or the hump already on this Delta variant. So this is. These are stocks that I think could do phenomenal with the triple income wheel for the next, say, 12 months. We're going to see, I think, a lot of these stocks will be trending higher. They've been kind of trading sideways to downward just recently, but I think there's going to be a renewed kind of interest in all these stocks. And so I think it's kind of a perfect time, especially if you can catch some of them going into earnings, which, the stock we're going to talk about today is Disney. And so Disney, I can't say enough about the business, and we'll go into the details of the analysis here in a minute. But it was definitely one of those stocks that got hit very, very hard during the pandemic. If you think about their business model, about 30% of their pre-pandemic revenue came from the theme parks in that segment there, and it basically went down to zero overnight, right? And then it just on the media side, their reliance on the theaters was an additional hit, and they've done a good job of kind of becoming this multi-channel media company anyway, and I think really wanted to launch their streaming services, and they were just getting Disney Plus started when the pandemic happened. So there's a lot of positives to like about the business. It's just one of those timing things where as soon as this company starts clicking again on all cylinders, it's going to be the type of business you want to be in, right? So, we still probably have this 3 to 6 month period where they're going to continue to kind of fight these headwinds, capacity limits, things like that at the parks and theaters and stuff like that. But just the way they've built their business, again, once that gets clicking on all cylinders, like it's going to be a phenomenal just stock to own. And so if we can in the meantime generate income by giving ourselves a margin of safety, there might be a little bit more downside. The company reports earnings on Thursday, and so I really like this cash secured put going into earnings, because again, I would love to be buying this stock on the dip if it happens, right? And we can still get a little bit good premium because of earnings on these cash secured puts. So this again, I think it's a great trade. Yeah, let's jump over into the stock profile and kind of talk about the business a little bit. So the strike zone we're looking at is 161 to 167. And the stock's currently trading right around 177. And so this is again one of those stocks, and we've talked about this this kind of theme where, if you're doing screeners, right? If you're using our platform and you're utilizing the kind of great screeners we have, I'm always encouraging you to do different types of screeners to kind of build your master watch list because there's certain stocks that aren't going to come up on your screeners that you should absolutely have on your watch list, and Disney's one of those stocks, right? Disney's a stock that, if you look at, safety and value and even momentum, I mean, it just looks like a kind of below average stock, right? It doesn't pay a dividend right now because they suspended their dividend in 2020, right? And so, I kind of titled this video anyway, Disney, no dividend, no problem, because we can create our own dividends, right? We can create our own dividends through selling cash secured puts. This company was a phenomenal dividend growth stock prior to the pandemic and them suspending their dividend. It was a consistent payer, it was a consistent grower. It had a bunch of potential as far as what the dividend could do in the future with all the cash flow. And I think that's all still out there. I think they will reinstate their dividend. They said a couple years. But again, we can create our own dividend, so it doesn't really matter. But what we care about is the future of the business, right? We always go into these triple income wheel plays as do we believe in the business longer term? And if we do, it makes a great kind of business to run the wheel on, right? And there's nothing to say that if we do end up buying the stock, that you can't hold it for a period of time and really get some of the capital appreciation that I think is coming in a lot of these stocks, especially one like this that it's a timing thing. That as soon as all of these things start clicking for them, they've just built an amazing business, again, a multi-channel media conglomerate with theme parks and cruises and all this great stuff to complement it. So again, love the business longer term, but it may not have come up on your screens, right? It's from a safety perspective, the operating history of all these cyclical businesses that got shut down look awful, right? And we'll look at those charts here in a minute, but it just looks awful from a fundamental standpoint. So you got to look a little deeper, right? You got to look out into the future. Same thing with value. I mean, the values don't look good because the earnings were crushed so badly that it's almost not applicable, right? These multiples almost aren't applicable to what we're looking at. So what I like about this business is we can get a good, nice premium because of the earnings on a stock that's actually a pretty low volatility stock, right? So this has a mean volatility of 28, which is on the lower side of kind of what we look at, because as if you've got a business or a stock that's low volatility, a lot of times we can't even get our 1% kind of target for our base strategy. But utilizing a situation where you got earnings and obviously a stock that's cyclical in nature and obviously has been trading all over the place because of that. We've got an opportunity to do that here. So the required margin of safety is only about 5.6%, which again is probably in the lower end of stuff we've looked at. That's even considering earnings, because all of our strike zone factors, right, go into this required minimum margin of safety. And so we look at volatility risk, which this one has a really nice risk profile, right? It's got a ranking of 8, which is good. Pullback indicator, I mean, it's already pulled back about 13% from its peak, and on a stock that only has a mean volatility of 28 and a historical volatility of 26, that's pretty good, right? That's already kind of pulled back, about half of what you'd expect this business to pull back on given its volatility profile. So there, again, there could always be a little bit more downside, but you feel pretty comfortable with this pullback with an indicator of 7. And then again, it reports earnings on Thursday, so we've got a little bit of a bump in required margin of safety there. But all that kind of equates to a pretty reasonable, 5 to 6% margin of safety. So let's take a look at the chart. And again, you can always click this little button here to pop the chart up, but I've annotated one already that we can look at. Okay, so this is the chart kind of going back to the pandemic, so you can kind of get a full picture here. And I kind of like to look, obviously back there to kind of see where the stock has come and, where I think it's going. And so, this stock broke down below 100 at one point. It was like down to $85 a share. That's when the parks were shutting down, all that stuff, and really started coming back. As I think, we started talking about the vaccines, and then this is where Disney Plus really started taking off. And so what I love about what this company has done, and why I think it needs to be on everyone's radar now, is during the pandemic, it kind of, again, and people have talked about this, where it's kind of pushed technology forward. It's pushed, things forward that may have taken, several years had the pandemic not happened to really, kind of move forward some of these ideas and some of these technologies. But from a streaming standpoint, they already had Disney Plus in the mix, but literally in 18 months, Disney and no other media company could ever, accomplish this. It just, so happens the properties and assets, media assets that this company has, made it possible. But they went from 0 to over 100 million subscribers on Disney Plus in literally 18 months. That's unheard of. I mean, so that kind of subscriber growth really is what kind of caused this breakout. And this was a very meaningful breakout. So kind of right in this, I think it was right around 152. When this stock kind of broke out right here, so this like huge kind of breakout right here was kind of the follow through on this pretty meaningful breakout. I mean, that was huge, and that was really, I think, the investor community saying, okay, wow, this is actually not a theme park business anymore. This is a real, technological, riding the technological wave here with streaming, which everyone kind of wanted the business to do, and they were able to capitalize. And so I've got 3 young kids, and I tell you, Disney Plus is just phenomenal. I mean, it's a must-have. The $7.99 price, I think, is probably too low for what they give you with that subscription. But side note, obviously, but this is again a business that I think the investor community is looking at differently, which is why I love this breakout. And so even though the stock has pulled back, and even though we're still fighting with where the earnings are going to be for that other big part of their business, with the theme parks. I really think they've got this kind of whole multi-channel thing going, and they're certainly going in their direction. So, we've been trading a little bit of a range here. We're still in an uptrend. We've got the 50-day above the 200-day, but it's kind of converging here. And so the stock's literally trading right around the 50-day moving average right now, but the 200-day is not too much further below this. So stock's at 177, the 200-day is right around 173, and then we've got, I think, 2 kind of these pullback areas that I think will offer some support. Right around 169, and then another one right around 163-ish. So, between 160 and 175, or kind of, I guess, that 173. So 160 and 173. I mean, we've got some pretty big support levels, I think, for the stock to have to break through. And so I really like that risk reward there, right? So you've got a business that broke out, and I would think this breakout level would just be a huge, massive support level here as well. So down at this kind of 152 level. So, that might be your draconian scenario on a pullback. But again, I think if you can buy anywhere, 160-ish kind of range, 160, 165 on a pullback, I think that's a phenomenal kind of entry point for this stock. Because again, I think this thing is going to start clicking on all cylinders probably in the next 6 to 12 months, and you're going to want to be in before that, right? dividend or not, right? And so if you're a dividend investor, you got to get this on your radar, because this stock is for real, and it's I think it's going to take off. So let's take a look just quickly at. Again, I'm not going to spend too much time on valuation, because I think it's not as applicable as it would normally be. I mean, you can see the current multiple is negative, so it's actually got an NA in there. But on a forward basis, this company is going to be profitable in 2021, and so their fiscal year ends in September, and so their 2021 is going to be profitable. They've had a couple profitable quarters already, and this coming up quarter is going to be profitable as well. Are expected to be profitable. So, really what you're going to see, and so in 2022, they're actually looking at right around $5 a share, so somewhere kind of in this range, and then it's going to go up to about $6.50 a share in 2023. So you're going to see this, you're going to see this earnings growth really kind of take off, I think, in the next couple fiscal years, and that's all projection. So based on so this is based on 2022 numbers, and then based on 2023 numbers of roughly $6.50 of earnings, you're looking at like a 27 times multiple. So again, it's getting back into that kind of reasonable level, I think, from a valuation standpoint, and so you can see why this stock doesn't rank well right now, because it's looking at historical numbers. But if we're looking at future numbers, I think it's going to paint a much different picture, and I think you're going to see the safety measure trend higher. And if we can get in before that, obviously that's ideal, right? And same with valuation as well. So let's take a look at the cash secured puts, see what we got. And again, we're looking at September options right now. So let's highlight a few of those. And so, I mean, we really got three that have really popped up on the screen here. And so remember our strike zone's 161 to 167. So that's why this 160 and the 165 are showing, in the strike zone here. And, obviously we've got earnings risk with all these. And it is a pretty low volatility stock, right? And so, our margins of safety aren't going to be huge, but remember our minimum required margin of safety was only 5.6% here. So anything above that would put us in the strike zone. So this 165, again, when we were looking at that chart, we've got some real support levels right around that level. So the 165 gives us 1%, full 1%. And I think normally on Disney, because of its volatility profile, you really wouldn't be able to get this type of risk reward where we can get our 1%, still be in the strike zone. We've got a delta, right around 20, which I think is good. But it does give us, that 6.6% margin of safety, which is greater than our minimum required. And so that would be our base strategy. I think it's a great one. And then, this aggressive one, takes us up to about 170. Obviously, if we went up to 175, which is why it doesn't show up here, the delta would be much higher, right? We want a little bit lower delta than the 175 is going to provide. So the aggressive play, this is about as aggressive as I would go, and that would be on the kind of low end of your aggressive target, but still get you 1.5%. Only about a 4% margin of safety and a 30 delta. But again, I think that's a level that absolutely could hold, right? Remember, we're still bumping up against our 200-day moving average right around 173-ish, I think it was, and then we got the 169 level from the low in May there. So I think that could be a level that holds again, which is why I feel real comfortable with the 165. And then the conservative 160, I think looks pretty good. This is meets our 0.5% minimum target there for The conservative side, almost a 10% margin of safety, and again a delta of about 14, I think, which is nice. So again, this is a stock, dividend or not, it's got to be on your radar. So again, if you're only doing, screens for dividend stocks, this type of stock's not going to come up, right? If you're only screening for high safety rating stocks, well, this type of stock's not going to come up, right? Because of what's happened to it just since the pandemic and what's happened with earnings. So you've got to have some different screens in there that will help you capture some of these businesses, right? And, sometimes it even takes just, thinking of businesses that have been hit pretty hard, so sometimes maybe you screen for, stocks that have low safety ratings, and you kind of go through them just mentally, looking at some of the businesses and say, okay, well, these industries I know have been hit for a reason, right? So maybe you can isolate some of those industries in your screeners, and come up with some of these potential opportunities and get them on your master watch list, right? And remember, so if you're using the Option Income Advisor platform, remember, you get all of this stuff as part of your subscription, right? So we cover 750 stocks. I've pre-filtered all the optionable stocks out there, so it's really only the most kind of liquid, stocks that I think make the most sense for the triple income wheel strategy. So we cover about 750 stocks on that list. And you get all this stuff, right? You get the strike zones, you get all these rankings, you get the ability to screen for different stocks based on all these different criteria. And then you can create your own watch list, right? You can create your own stock watch list, which I keep driving home for you. Build that stock watch list. Build that master list that you can go back to. And again, I call it your well, right? You go back to this well over and over and over again on these stocks that you like, because you can consistently write puts on these stocks, right? And if you've got this big master watch list, you're always going to have option opportunities to put on when your cash frees up. So the platform's kind of built to not only help you analyze, what we do every day on this, that we do a trade of the day. I actually walk you through the exact profile that I use as I put my money to work and put my clients' money to work, and you'll have access to all that with the Option Income Advisor subscription. So that's what I have. That's the trade of the day. Disney, I think it should be on your list. Don't get caught up on the dividend again. You can create your own dividends, which is the beauty of this strategy. So that's what I have. Take care.